Hi, my name is Joshua Barker, Investment Advisor at RiverX. One of the asset classes that we look to construct investment portfolios with is Australian commercial real estate. This asset class has evolved a lot in recent years on the back of the global pandemic, inflation crisis and the advances in artificial intelligence. Today we'll unpack some of the key trends that are shaping the commercial real estate market in 2025, look at how best to manage those risks involved with this sector and how best to utilise this asset class to achieve investor objectives. To get the latest insights, I'm joined today by Charter Hall's Direct CEO, Steve Bennett. Steve, thanks for joining me.
Thanks, Josh. Pleasure to be here.
Steve, could you provide a brief overview of Charter Hall and the makeup of the Australian commercial real estate market?
Sure. Many people aren't aware that Charter Hall's actually the largest owner of real estate in the country. We've got more than 1,600 assets spread across all the core real estate sectors of office, industrial and logistics, convenience retail, as well as social infrastructure. One of the things that sets Charter Hall apart, not just our scale, but because we do have such great access to the tenant customers, to data, we are able to pick up on trends as we move through different parts of the cycle. And where we're at in the cycle, we had peak valuations for most asset classes in property around June 2022. At the recent December 24 valuations, we saw asset classes such as industrial and logistics and convenience retail bottom out. In fact, there were some slight increases. And the office market, whilst it came off a little bit at December, we are seeing stabilisation in terms of cap rates, and we expect, if we're not at the very bottom for the office market, we are very close. So that is something that we thought would happen, and it is playing out as we move through into the next part of the cycle, which will be that growth phase.
Office buildings have received a lot of attention in more recent times as people have changed the way that they work. How does Charter Hall view the office market?
Look, we think the office market is a key part of companies and governments' workplace solutions. I recently presented to 500 people at a Property Council Outlook. I was asked the very question on working from home, and my answer was very much along the lines of the trends going one way. Most large organisations, big government entities want their people back the majority of the time. I'm not saying that means 5 days a week, there'll still be flexibility, but what people are realising is that having a well-located property with great amenity is great for their team culture, productivity, and we're seeing less and less inquiries around working from home from our tenant customers, as well as our large institutional investors who very much understand that the trend is back into the office. So if you look at the investment markets for office buildings, the supply forecast over the next 5 years is increasingly becoming constrained. In fact, based on our research and data, we think the next 5 years worth of office supply is going to be around 35% less than the prior 5 years. So what does that mean? It means we've got a rapidly increasing population, we've got increases in white-collar employment growth, we've got an increasing trend back into the office, and we've got a decreasing trend for office supply. So we do expect that the office buildings that are well located, provide great amenity, close to public transport, close to clients, are going to be an increasing demand. And in fact, that is the trend we're seeing in tenant users. There is a big bifurcation, so demand splitting, where the prime, highest quality assets are attracting all the tenant inquiry and tenant lease up, and the lower quality or secondary assets are the ones tenants are moving out of. So what it means is that we'll continue to focus on prime quality assets. Where we do have assets where we think the investment demand and tenant demand is changing or will likely to change, don't be surprised if we sell that. But that's something we've been doing for a long time at Charter Hall, where we sell assets and continue to upgrade the portfolio quality. And in the office space, it's even more important because of what tenants are telling us they want to be in.
We've received a lot of questions from our clients on the rise of e-commerce and in artificial intelligence trends. How is the Australian commercial real estate being shaped by?
Yeah, look, some of those trends have been around longer than others, and I'll pick up e-commerce, for example. We've got a very large industrial and logistics portfolio, not just in the direct suite of funds, which myself and the team look after, but the wider Charter Hall group. That is one of the tailwinds that's absolutely been fundamental to the strong tenant take-up. E-commerce, where you can order things at home. I do a lot of my grocery shopping at home. That continues to grow. It's a part of the reason why the industrial and logistics vacancy rate in Australia is only 2.5%. In fact, 5 of the 6 lowest vacancy rates in industrial globally are in Australian markets. The e-commerce trend isn't something that's going to go away. We talk to our major tenant customers in this space. What they're doing in those buildings is changing. So a lot more automation, being much more discerning in their locations. They've measured down to the dollar how much it costs to ship goods and where they want to site these facilities. So that's something that will continue. In terms of the AI side of things and artificial intelligence, we're seeing an uptick in demand for even office space for those knowledge users in those areas. Those IT companies, even financial services, continue to hire staff into that space as they're trying to drive efficiencies and ultimately improve the customer outcomes for them. We haven't at this stage gone into building our own large hyperscale data centres, particularly for the audience, which we discussed pre this around high net wealth and retail investors, self-managed super funds. We haven't at this stage thought that taking on those type of development risks in that space is suitable to the capital that we're looking after.
We've seen several new investment opportunities in the retail space recently. What's the investment rationale behind accessing the retail sector, particularly at this point in time?
Look, there's 2 main subsets of the retail spaces. The big malls, which have a lot of discretionary tenants in them. The way Charter Hall's chosen to play the retail sector is focusing on that convenience retail. So think of your Coles, your Woolies, neighbourhood centres. They're convenient, they're local. Your Bunnings, your pubs, your service stations. And the reason why we're focused on those is the cash flows are very resilient. You can get long-term leases to very strong tenants, so they'll go through different cycles. A lot of the recent offerings in the market have been single asset property syndicates in that retail space. I won't comment on those, but what we like about the convenience retail is you don't have those discretionary tenants. You don't need to worry about the releasing spreads. You don't have very large asset sizes where you need to very much time the market in terms of when you sell and exit the property. A lot of these convenience retail assets are at a very attractive price point for private syndicators and high net wealth investors, even smaller and large institutional buyers. So when we're buying real estate, we're not focused just on the entry point, but how do we exit these assets at the right time to maximise value for our clients? And we think where we're at in the cycle and structurally in terms of the supply of these, it's something that we really like in terms of, out of all the core real estate sectors, convenience retail has already bottomed, and we think there's a good runway ahead to drive investor returns off the back of that.
So for investors looking to access the Australian commercial real estate, can you talk through an investment idea that gives investors access to some of the different sectors that we've spoken about?
Sure, and look, I'll always preface this type of question with what I'm about to say shouldn't be taken as financial advice. If you've got questions, do speak to an advisor or someone that you trust. One of the ways which we think does make a lot of sense for investors at this inflection point is a diversified investment vehicle. For example, we've got the Charter Hall Direct Long WALE Fund. That means we focus on long-term leases. But something that's a little bit different with this fund versus some of our other sector-specific funds is that we can tilt the allocations into different sectors as we see opportunities come up. So for example, where we get opportunities which we think will deliver outsized returns in that convenience retail or industrial logistics, we can take advantage of those. And then as we move through the cycle, there will inevitably be a time when there's some great returns, and we think that time's rapidly approaching, by the way, in the office sector. So LWF is not only diversified by sector, but also geographic region and tenants. So the top 3 tenants, for example, are government, Bunnings and Coles, who make up more than 50% of the net income of that fund. And we've purposely put a weighting very heavily into New South Wales and Queensland. Around 85% of the portfolio's assets are located there, because we think that those 2 states, at least in the near term, will provide the best growth opportunities. But as I mentioned, one of the benefits of LWF is that we can tilt not only the allocations by sector, but also geographic locations as well over time.
So that's, getting exposure to those tactical allocations in specific areas, but also being diversified at the same time.
Yeah, and that's off the back of what is a very stabilised core portfolio. So the fund's about 334 million of assets. The current distribution rate 6.9%, so great level of income, and the distributions are paid monthly to investors. So for those clients that require regular income, it's a nice way to get it. And it's interesting, we've had a lot of inquiries on these type of funds more recently, particularly as other sources of income and yield are expected to come off with interest rates falling. So it's a good core way to access institutional grade property that generates a very strong level of income, as well as the opportunity for capital growth over time.
Yeah, maintaining that income, especially if it is monthly, is something that our clients are very interested in, and it's something that as an advisor I'm looking around for at the moment in order to gain access to that, with yields coming off and I think those cap rates looking to increase. Well, Steve, thanks for your insights and thanks for joining us today. If you do have any questions on any of the topics that we've discussed, please feel free to reach out to myself or the team at RiverX.